Okay, so what if I told you the first warning sign for America's AI trade didn't even happen in America? It happened 7,000 miles away, South Korea. And look, if you don't follow Korean stocks, I get it. But stay with me here, because this one's going to hit close to home. So for months, the Korean market looked unstoppable. I mean unstoppable. Money was pouring into two names, Samsung and SK Hynix. These are the guys making the memory chips that basically feed the entire AI boom. And then the mood flipped. The Kospi fell hard. All these leverage products turned a normal drop into a full-on collapse. And it got bad enough that regulators had to literally step in and cool the whole thing down. Now, real quick, before anybody freaks out, I'm not saying the US is next. I'm not. Korea and America are different markets, different structures, whole different animal. But here's what Korea just gave us. A stress test. A live, real-time demo of what happens when one hot story, a tiny handful of companies, and a mountain of borrowed money all pile into the same trade. So today I want to walk you through what happened, why it matters over here, and honestly the most useful part, the actual warning signs are worth watching. Let's get into it. All right, start with the two companies. When people think AI chips, everybody goes straight to NVIDIA, right? But here's the thing. An AI processor is basically useless without fast memory feeding it data. That's this stuff called high bandwidth memory. And the two companies that own that market, both Korean. So as the AI hype exploded, investors just stampeded into these two stocks. And by this summer, Gathis, Samsung and SK Hynix together made up roughly half of the entire Korean stock market. Half. Two stocks. Think about that. The index has hundreds of companies in it. Hundreds. But when two of them are half the weight, that index isn't telling you about Korea's economy anymore. It's telling you one thing, what people believe about two stocks. That's it. And look, concentration feels amazing on the way up. The big guys rally. The whole market looks healthy. Headlines are celebrating records. More money piles in. And rising prices make everyone feel like they were right all along. It's a loop. But concentration cuts both ways, man. When those same two stocks fall, diversification does nothing for you. Zero. The same companies that carried the market up drag it right back down. Confidence gets magnified, and so does fear. Okay, ingredient number 2, and this is where it gets wild. Leverage. So in Korea, you've got 14 million retail investors. That's 1 in 4 people in the whole country. And they have a name for themselves. They call themselves ants. Because one ant, tiny, doesn't matter. But 14 million ants moving together, they can carry the entire market. And here's the part that honestly kind of breaks my heart. For a lot of young Koreans, housing got so expensive that owning a home just stopped being realistic. So the stock market wasn't a hobby for these people. It was the last door to building wealth, the last one. So they didn't just invest. They borrowed to invest. Margin balances hit a record, almost 39 trillion Korean won. And a ton of them didn't even buy the stocks directly. They bought these leverage products, funds literally engineered to double the daily move, which, hey, beautiful math on the way up, brutal math on the way down. Stock drops 10% in a day. Congratulations, you just lost 20 in one session, and then come the margin calls. So here's how that works. You buy stocks with borrowed money. The stocks fall below your broker's line, and the broker basically says, hey, wire us cash by tomorrow morning, or we sell everything, and they mean it. They don't wait for a better price. They don't care that you're down 40%. They just sell. And this is where a normal sell-off turns into a machine. Watch this. Prices fall. That triggers margin calls. Margin calls force people to sell. Forced selling pushes prices down more. And that triggers the next round of margin calls, round and round. At that point, nobody's selling because they changed their mind about Samsung. They're selling because the system is making them. And that's exactly why Korea got so violent. The Kospi lost about a fifth of its value in the first part of July. They had to halt trading circuit breakers, and the regulators, they didn't treat this like normal market noise. They froze new leveraged products, banned the ads for existing ones, raised the bar on who's even allowed to buy them. And when a government pulls a product off the shelf, that tells you everything you need to know. Now, here's something else that happened during all this. Something quieter. And honestly, this is the part that stuck with me. We pulled hundreds of raw public reactions to this story off the open internet. Not our audience, not a poll, just regular people talking. And you know what the number one thing was? It wasn't fear. It was exhaustion. People saying, I don't trust this market. And in the same breath, and I don't trust the crash warnings either. They've heard the alarm so many times. They unplugged it. Just unplugged it. And remember that, because markets can survive fear. They really can. What they can't survive is nobody paying attention when it actually matters. Okay, so now America, and this is where I need to be careful, and you should be too. The U.S. market is way bigger, way more diversified, more sectors, deeper markets, different investors. So anybody doing a straight copy-paste comparison is being lazy. But there are three things that line up, and they deserve your attention. Number one, concentration. A small group of mega caps has been carrying a massive share of this market's performance. And look at what they actually do. Chip designers, cloud providers, data centers, platforms, different tickers, man, same bet. Number two, the spending, Amazon, Microsoft, Alphabet, Meta, they're throwing something like $700 billion this year at data centers, chips, networking, power, $700 billion. And here's the thing people miss, that spending doesn't disappear. It becomes somebody else's revenue. The cloud company buys processors. The processor needs memory. The data center needs cooling, construction, electricity. So one company's expense is literally another company's earnings. Now, that doesn't make the revenue fake. The buildings are real. The demand is real. The risk is that the market has already priced in years of success before anybody knows what the return on all this spending actually is. If the money shows up fast, genius. Everybody's a genius. If it shows up slow, some CEO somewhere cuts the budget. And that's a totally reasonable move for his company. For the suppliers priced for infinity, that's the earnings collapse. Number three, leverage. And this one's fresh. FINRA just reported U.S. margin debt at $1.53 trillion for June. That's a record, all time, and it's up more than 50% in 1 year. And listen, that number only counts old school margin accounts. It doesn't count leveraged ETFs, doesn't count options, doesn't count portfolio margin. So that record, that's the floor, not the ceiling. Now, I got to be straight with you. High margin debt is not a countdown clock. It can't tell you the day. Markets can climb for years with leverage this high. But borrowed money makes the whole system unforgiving the second the mood turns. That's the deal. So forget when's the bubble gonna pop. Nobody knows. Nobody. Anybody who says they do is selling you something. The better question is, what would actually force investors to rewrite the AI story? And there's 4 things I'm watching. First, a major cloud company cutting its AI spending. And not because they found a cheaper way to build, because demand or returns came in soft. That's the one. Second, orders weakening across the whole supply chain at once. Processors, memory, networking, power, one bad quarter from one supplier, whatever, a pattern across all of them. That's everything. Third, when the price stops matching the performance. If these companies keep posting strong numbers and the stocks keep falling anyway, the market's telling you expectations already left the building. And fourth, credit. Rising margin debt is fine, while prices are up and money's loose. The danger shows up when falling prices meet, tighter lending, and brokers start knocking. That's it. Spending, orders, earnings reactions, credit. That's your dashboard. Now, is there a bullish version of all this? Absolutely. AI adoption keeps growing. The cloud guys turn all this infrastructure into real profit. Memory demand stays hot. Korea calms down. And this whole thing goes down as a painful correction inside a much bigger boom. Totally possible. And the bearish version? Spending outruns the revenue. One big player cuts. Suppliers guide down. The crowded trades unwind. The leveraged guys get forced out. And the market finds out that a dozen different bets were actually one bet on AI spending never ever slowing down. Right now, both are on the table, and I'm not going to pretend otherwise. So here's the real lesson from Korea. It's not that AI failed. It didn't. It's not that every tech stock is overpriced. And it's definitely not that a crash is scheduled for some specific month. The lesson is simpler than that. A great story can still build a fragile market when too much money crowds into too few places and too much of that money is borrowed. That's it. That's the whole mechanism. And for you, the takeaway's way less dramatic than the headlines and way more useful. Know what you own. Know how concentrated you are. Know if your fund resets daily. And never, never assume that a great company makes every price safe or every leverage product with its name on it. Korea didn't show us the future. Korea showed us the machine. When concentration, leverage, and sky-high expectations all feed each other, markets go up faster than the fundamentals, and they come down faster than anyone can react. So let me know what you think. Was Korea a one-off, or was it the first domino for the whole global AI trade? Drop it in the comments. I read them. And hey, if you want more no-hype breakdowns like this, subscribe. Appreciate you watching. I'll catch you in the next one.